Okay, good evening, everyone. I want to welcome us to the online class for SBR, Strategic Business Reporting, and of course, the equivalent course in ICANN, that's Corporate Reporting. So before we start, I want to confirm if you can hear me. Can you just, someone should just go to the chat room to confirm that so that we can start straight away. Okay, thank you very much, sir. Thank you. All right, we are welcome once again. Yesterday we commenced lectures around SBR, and basically we were able to build some foundation as to the course, so that we can really have a smooth outing. So basically, we take a look into the conceptual framework, and where we said the ISB conceptual framework is a set of theoretical principles and concepts that underpins the preparation and presentation of financial statements. We also take a look at the purpose of the framework, the advantages, and of course, the disadvantages. We're able also to establish to say that every countries of the world has adopted IFRS except the US, which they still have the US GAAP in force. Then from there, we took a look at the content around the conceptual framework, the underlying assumption, the qualitative characteristics of financial statement, the element of financial statement. We look at the recognition of the element of financial statement, measurement, including the recognition. Okay, so the whole essence is to give us a fair idea of what we are to expect in the course or during the course of this program. Okay, so I want to believe we are set for this evening's class. So we are going to start straight away. This is 9:04, 9:05, and we need to start because we have a lot to cover. So obviously, I'm going to start with impairment. If time permits us, we take a look at IFRS5. It's within ICANN and ACCA syllabus. And of course, IAS10 is quite important. And IAS21, the effect of changes in foreign exchange rate. So hopefully we should be able to cover these four standards between today and tomorrow by God's grace. Then next week, we are going to commence group accounting. Then we'll also come back to these standards, okay? So you are all welcome once again. So let's start straight away. IAS36 talks about impairment of assets, okay? Impairment of assets. So I'm pretty sure we should have been exposed to the standard, but notwithstanding, like I tried to establish yesterday for candidates writing ACCA, SBR, whether in September or December, okay, you need to step up from financial reporting. So the same way with ICANN candidates, okay, so, but the main challenge is let's even understand what the standards are all about. Then from there, we can now decide or, trying to see what the examiner might test around here. So let me start straight away. And let me also remind us, I also tried to establish something yesterday that when I lecture naturally, I don't like looking at the screen or the material. I just want to flow, okay? But I'll try as much as possible to make sure that whatever I'm discussing is on your screen. So all I need you to do for me is to listen very well. I'm sure we know our rules. Okay, everybody should be muted on both video and audio so that we don't interfere or interrupt the class. Okay, so just listen in case you have questions. Put it up on the chat room. Once I see the flashlight, I will definitely stop by to attend to your questions. So you just listen to me, and as I explain, I also pick out the areas you should accept. You might expect the examiner, to be testing. Okay, and for ACCA candidates, obviously, you have to prepare for scenario questions. All your questions are scenarios, so you need to be conversant with reading scenarios questions and all that. But for ICANN, it's still a little bit of scenario, preparation of accounts and all of that. Okay. Now, impairment talks about economic reduction in the value of an asset. Okay. Let's say impairment. It's economic reduction in the value of an asset, right? What does that really mean? I'm coming back there. So let me talk about the carrying amount of an asset. So when you say the carrying amount of an asset, is the amount at which an asset is recognized on the financial statement after deducting accumulated depreciation and accumulated impairment losses. Does that make sense? So when I pick up financial statement, and for example, I see PPE, they said $100 million, for example, all right? So that 100 million is what we call the carrying amount. In the under the old standard, it's called the net book value, okay? So now, so when I say the 100 million, that is the carrying amount, okay, under IFRS. Now, the issue now is before the 100 million was gotten, they must have removed accumulated depreciation. Why is it accumulated? Maybe for the last 2, 3, 4, 5 years, as the case may be, and probably accumulated impairment losses. Okay, so they remove it from the cost of the asset to arrive at the carrying amount. But like I will always say, no examiner is going to start asking you what is carrying amount. But if you don't understand it, there's no way you can tackle questions around this area. Okay, so I've talked about impairment, which is the economic reduction in the value of an asset, and I promise you that I'm coming back there, to break it down a little bit. And of course, I've been able to break down the kind amount of an asset to be the amount at which an asset is recognized on the financial statement after deducting accumulated depreciation and accumulated impairment losses. So before I move further, let me talk about depreciation. Impairment and depreciation are never the same, okay? Impairment and depreciation are not the same. So let's take a look at what depreciation is. Depreciation is systematic allocation of depreciable amount on the cost of an asset, okay? So when I systematically allocate depreciable amount on the cost of the asset, I would say that is depreciation, and all of that. So that's why I depreciate. So obviously, at the end of each report, I must depreciate. To depreciate. When I carry an asset value model in accordance with IAS40, I will not depreciate. Okay, I will not depreciate. I will not depreciate. Okay, so you need to understand that. You need to understand that. Okay, all right. Somebody is saying it's making some weird sound. Has it stopped now? Can you confirm that? Okay. Okay, so I will not depreciate if I carry an asset under fair value model. Okay, so I want to believe the voice is okay now, right? Okay, all right. Now, so that is depreciation. So how do I get my depreciable amount? Okay, listen up. How do I get my depreciable amount? Oh, did I still wave? Are you sure? So the voice should be okay by now. I'm on loudest volume. Oh, okay. Okay, so how about now? It should be fine. Okay. I think it should be fine. Okay, somebody else is fine from your hand now. Okay, thank you. All right, so let me continue. Thank you very much. Now, so how do I get my depreciable amount? So say, for example, you could use a straight line method, reducing balance method, or probably some of the SDGs. But obviously in your exams, you always see, straight line method is quite popular amongst the examiner. Okay, so when I'm using the straight line method, there's a formula for that. I say cost minus residual value over number of useful life, right? Or you say cost minus salvage value or scrap value over number of years. So the figure you get there is all called depreciable amount. So you depreciate for 1 year, okay? So that's for 1 year. So depending on the number of years, from the date of purchase and up to the period you are computing your impairment, or maybe you want to classify the asset as held for sale, All right. So you compute up to that period. So have your carrying amount. Okay. So obviously, depreciation will happen at every reporting period, but impairment may not happen. Okay. So that's why impairment is defined as economic reduction in the value of an asset. So I've been able to tell you what impairment is. I've told you what depreciation is, and I've told you what kind amount is. All right. So let's talk about impairment loss. Okay. So obviously there is a difference between impairment and impairment losses, right? So impairment loss, listen up. Impairment loss is the amount at which the carrying amount of an asset exceed its recoverable amount. Okay, so impairment loss is the amount at which the carrying amount of an asset exceed its recoverable amount. So when I pick up the financial statement, or probably I pick up an asset and I looked at the carrying amount, once it's higher than its recoverable amount, can you see? So this is my carrying amount, right? And this is my recoverable amount. Once it's higher, the difference between the two is impairment losses. Is that okay? So the question now is, what is recoverable amount? So let me quickly say that recoverable amount is the higher of fair value less cost to sell and value in use. You have to put that in your head right away. Okay, so that's the principle. If you don't understand that principle, you can't solve questions. It's as simple as that. Okay, so the higher of fair value less cost to sell and value in use is known as recoverable amount. I'm still coming there. Okay, I'll still try to break it down at some points. But let me just say that to say when the carrying amount is higher than my recoverable amount, then I say the asset is impaired. Okay, so the difference between the carrying amount and the recoverable amount, say for example, let me put some figures to it. Let's say my carrying amount is $5 million, for example, all right? And my recoverable amount is $3.5 million. Can you see that? Recoverable amount, if I needed to sell the asset, how much am I going to recover? 3.5 million. But in my account, in the books, I'm carrying it at $5 million. Okay, now, is that making sense to you? What it means is it does not make economic sense to carry an asset at more than their recoverable amount. So the objective of IAS36 is to ensure that assets are not carried at more than their recoverable amount. Remember the last time I talked about substance over form principle. So the economic reality is to say that when the asset, the worth of that asset is actually 3.5 million. So why am I carrying it at $5 million? Did you see that point? Remember the qualitative characteristics of financial statement, where we talked about relevance and faithful representation. And when it talks about faithful representation, it has to be complete, it has to be neutral, and must be free from error. Are you seeing the linkage now? That asset should be written down to its recoverable amount. Okay, the asset should be written down to its recoverable amount. That's what the standard is saying. So that's why if the kind amount is $5 million and the recoverable amount is 3.5, so what it means is that asset has suffered economic reduction, and that is not depreciation. Okay, so that is not depreciation. And obviously, impairment may not happen every year. Circumstances, some conditions, as highlighted by the standard. Okay, so that's the issue. That's the issue you need to know. So the difference between the two, which is a 1.5 million, okay, $1.5 million, I take it straight to profit or loss account. I take it straight to profit or loss account as impairment losses, So let me talk about recoverable amount. We said recoverable amount is the higher of fair value, less cost to sell, and value in use. Everybody understood how to compute what's it called, carrying amount. Let me even tell you straight up. Anytime you identify a question and it's around impairment, okay, IAS36, an examiner asks you to compute impairment losses, or he just asks you what will be the accounting treatment, or let's say in SBR exams, he has even computed it for you and ask you to check whether the computation is correct. Okay, just know that you needed two variables. Okay, you needed two variables. You needed carrying amount and you needed the recoverable amount. It's as simple as that. That's the two things you need. And how do I get my carrying amount? I simply look at the cost of the asset I remove accumulated depreciation and accumulated impairment losses. It will be there in the question, okay? Then how do I get my recoverable amount? Okay, how do I get my recoverable amount? I will say higher of fair value, less cost to sell. So when you look at the question, the examiner might likely give you the fair value of that asset, okay? What will be the fair value if the entity intends to sell the asset? And what is the cost that will be incurred in selling that asset? That's what they call cost to sell or cost of disposal. Okay, so you remove it so that you can get your net selling price. So you have that figure at your fingertips. So let me just give a figure to that. So let's say after I've done that, I have 450. Okay, I have 450. Then now listen up. Most likely at this level, the examiner may not tell you straight up that the fair value of the asset is 500, for example, and the cost to sell is 50, so that you can get 450. Sometimes the examiner can say, if the entity intends to sell the asset, it will be sold at $500. Can you see that? Okay, so that's to tell you that that's a fair value. You don't need a soothsayer start telling you that. Okay, now if you say if the entity intends to sell the asset, that is the fair value of that asset. Then you remove 50, which is the cost of disposal or cost to sell, so that you have 450, my net selling price. Then you go to the other variable, which is value in use. Now listen to me here. When it comes to value in use, I am not selling the asset. I want to continue to use the asset. So that's why it is called value in use. So if I continue to use the asset, how much cash flows will it generate? And you want to agree with me that those cash flows are into the future. In fact, IAS36 says don't do more than 5 years because of macroeconomic variables that can change at any point in time. So you have to forecast those future cash flows. Okay, so because they are future cash flows, IAS36 now says you have to discount to present value. Okay, you have to discount to present value. So obviously, the examiner is going to give you the cost of capital. So you could say 10%, you could say 8%, 12%, okay, or as the case may be. So all you need to do is to discount. You press your calculator and you try to discount. So how do you discount? You do 1 plus R raised by minus N, okay? R stands for the rate, which could be 10%, and N stands for the number of years, maybe year 1, year 2, year 3, as the case may be. So that's what you're doing. So I have that figure. So let me assume that after doing that, I have 300,000, okay, or so say $300. Remember, I have 450 for fair value, less cost to sell, okay? So, and I have 300. So which one is higher? Obviously, it's fair value, less cost to sell. So that automatically becomes my recoverable amount. I now compare with my current amount. Once it is lower, the asset has suffered impairment. But if it is not low, if it's higher than my current amount, that means the asset is not impaired. I continue to carry it at its current amount. I just want to assimilate what I just said, right? So now I'm giving some minutes. Okay, so that's that. Okay, so now we needed to learn 2 more things, okay, before I go into questions. Then I take you the last aspect of our impairment, which is cash generating units. Okay, then I'll now pick you up on what to expect from the examiner. Although I've been trying to say some of them, you know, as I was explaining. Okay, now we needed to learn maybe 2 or 3 more things. Now, what I've just explained to you, you know, when it comes to determining if an asset has suffered impairment, is what we call impairment test or impairment review. Okay, that's what we call impairment test or impairment review. But obviously, if you look at big companies, maybe in Nigeria, for example, you want to look at Guinness Nigeria or Dangote Nigeria. Okay, so obviously they can't, you know, practically they may not be able to carry out impairment tests, you know, for all their assets at the end of the reporting period, say December 31st. Okay. Now the standard now says that before a company or an entity can carry out impairment tests, there must be indicators of impairment. Okay. There must be indicators who can be internal indicators or external indicators. Okay. It could be internal indicator or external indicator. What does that mean? If those indicators are not there, I will assume, remember, under IFRS, a lot of assumptions. So I assume that the kind amount of those assets are not materially different from a recoverable amount. But once I see those indicators, that is when it's going to be a kind of trigger that will tell me that I need to carry out impairment test. So those internal indicators, for example, maybe during the year, fire got part of your plant, okay? So it's an indicator to tell you that that plant would have suffered impairment. Another example could be the performance of the asset is worse than expected. Sorry, everything I'm saying is somewhere in your note. Okay, I think I'm here. All right, sorry. Now, so the performance of the asset is worse than expected. So that's also a classical example. Maybe an asset I used to produce 1,000 cartons per hour is now struggling to, I'm just saying for example, right? Okay, or 1,000 products per hour is now struggling to produce maybe 700, 600 products per hour. So the performance is declining. So that could be a trigger to say the asset has suffered impairment. So those are internal sources of information. Okay, then you also have external sources. One classical example is COVID-19. Okay, that sees some assets value to have declined significantly. Okay, and of course some asset value also went up. Okay, well, here we are looking at impairment. So COVID is an external indicator that will suggest that entities are supposed to record higher impairment losses. Okay, so you have so many examples. You could see them in your notes. You can just put 1 or 2, 3 points in your memory in case the examiner is picking you up on that. So obviously, at this level, maybe aside ICANN exams in the corporate reporting, but in SBR, the examiner will never ask you directly to say what are the what are the what's it gonna indicators of impairment. It will never ask you. However, it could form part of your response, maybe in a scenario question, okay, or it asks you to assess, whether the company has complied with IAS36 in determining whether an asset is impaired or otherwise. So that's how you need to think. So in fact, when you look at scenario questions in SBR, the answer is in your memory. You know that, but you may not be able to produce it because you are confused already. For example, in a scenario, the examiner just gives you so many information and he asks you to assess whether the method adopted in determining, if those assets have suffered impairment or not is correct. Then you are thinking, what are they asking me to do? So you need to, that's why it's called SBR, Strategic Business Reporting. But when you write in, I can assure you, they can ask you directly, what are the internal sources of information, and of course there are external sources of information when it comes to determining if an asset is impaired. Now listen to me, there are 5 classes of assets that must undergo impairment tests, whether or not they suffer their indicators of impairment. Okay, so you don't need to wait for this class of assets for you to carry out impairment tests. Okay, at the end of each reporting period, they must undergo impairment tests, whether or not they are indicators of impairment. Number 1, goodwill acquired in business combination. Is in your note somewhere there? Okay, goodwill acquired in business combination. Number 2, intangible asset with indefinite useful life. Intangible asset with indefinite useful life. Okay. Number 3, asset classified as held for sale. Asset classified as held for sale. Goodwill acquired in business combination, you see that around IFRS3. Okay. Intangible asset with indefinite useful life, you see that under IAS38, intangible asset. Then asset classified as held for sale, probably we should be able to look at it, or maybe I just introduced it to IFRS5 this evening. Okay, you see that under IFRS5. Okay, asset classified as held for sale. Then another one is asset bought with a view to resell. And buying an asset with intention to resell, it must also undergo impairment test. And the last one is intangible asset during their development stage. Sometimes people say intangible asset that is not yet completed. Okay, so intangible asset during their development stage. Those are the 5 classes of assets that must undergo impairment test, whether or not they are indicators of impairment. So if you are writing SBR, for example, the examiner can mix it up, bring in those assets, okay, and tell you that maybe your director or maybe your director of finance is thinking okay, so let me see. Okay, sorry, let me look at these comments. Is it possible to scroll the page point discussing this to enable me to focus? Okay, yeah, okay, I think I'm somewhere here. Yeah, it's just down there. Okay, yeah, okay, all right. So in this scenario, you could be told to say your CFO is saying, so for some certain class of assets, they may not, they may not undergo impairment tests. all right? And they give you, in that scenario, they give you, those classes of assets. So all you need to do is to check whether it falls within these 5 categories. Okay, if it falls within these 5 categories, then it becomes an ethical issue. Did you see now? I'm stepping up from FR. You just have to step up. So it becomes an ethical issue. Okay, if this exception are not complied with. So they must undergo. There is no excuse. You don't need to see any indicator, okay? But if they are outside these 5, you have to see, flashes that should be indicator. Then it could also be that there are indicators, okay? There could be an indicator, and the examiner can pick you up, okay? So the fact that I carry out impairment test does not necessarily mean I have to record impairment losses. So you could see a question where the examiner is saying, okay, fine, even though there are indicators, but people, the regulators were surprised that most entities did not record impairment losses despite COVID-19 pandemic. So how can they use IAS36 as earnings management? So it becomes an accounting issue, okay? So you have to pick it, you have to be able to link it up and, produce your answer. So what it means is beyond knowing the standard, all right? So that's why it is ACCA. It's beyond knowing the standard. You know it, okay, fine. Can you apply to real life scenario and, you're able to bring out strategic issues or, or ethical or accounting issues around that. Okay, so that's it. All right, so let's take a look at this question. Okay, I think I've told you what you need to learn. Okay, yeah, I think I didn't take out anything. Yeah, brilliant. Okay, now, so let's take a look at this question. Yeah, you need to learn one more thing. Yeah, it came to my head. But let's look at this question first, then I'll teach you that one more thing. We look at another question, then we go straight to cash generating units. Hopefully, we should be able to deal with IAS36 tonight. And of course, we start off with, I'll go straight to IFRS5. Now, let's take a look. Now, let me look at the requirement. It says, is there item of plant impaired? And if so, by how much? All right. Now, this is quite straightforward, right? Just to, build us to, I'm trying to build you up to a level. Now, you already asked me, is it impaired? In fact, at CR or SBR level, don't expect the examiner to ask you or to give you this kind of requirement. So I'm going to show you the kind of requirement you should expect. But because I'm teaching, so I needed to take you from the grassroots to the to the complex roots. Right. Now let's take a look. It said an item of plant is included in the financial statement at a kind amount of $350. The present value of the future cash flows to operate the plant is $320. The plant could be sold for net proceed of $275. But let me tell you something. This is, I think when I wrote this, I saw some nasty questions. They are so simple. So they can go as low as this. So don't always expect complex questions. And I also saw some complex questions. Okay. So they can ask you so low, like you're like, am I writing this exam? So it's possible. And if it's not taken, you're confused. You don't even know what to do because it's so simple. Okay. So it's possible. So that's why you need to understand. Now, when I say this question, I already told me, is asking me, is the item of plant, is it impaired? So that's the issue around here. And I told you, once you have determined that this is impairment, you needed 2 things. I needed carrying amount and I needed my recovery amount. Then I asked a question, where's my carrying amount? Okay, can you see it here? He said the carrying amount is 350. You see now? So it's quite straightforward. So I pick it up. That's my carrying amount. So I have seen one variable. I needed one more, which is recoverable amount. And that is the higher or fair value, less cost to sell and value in use. Then I asked a question, where is my fair value? He said the plant could be sold for a net proceed. He has computed it for me. Okay, he said net proceed. Can you see that? He has computed it for me. So I pick it out. Oh, wow. That is my, what's it called? Fair value less cost to sell. So I have a figure, 275. Then I ask a question, where is my value in use? In my head, I will recall that future cash flows needed to be discounted to present value. Then I asked, he said, the present value of future cash flow. Can you see? The present value of future cash flow he has discounted for me. Can you see that? He has discounted it for me. He said present value. If he has not discounted it for me, we never use the word present. Okay, he will not use the word present. So that's what we need to know. Okay, that's a flashlight. So it's quite difficult for you to cram. You can't even cram. How? Okay, so he has discounted for me. Now said to continue to operate the plant is 320. Can you see that? Okay, so it's 320. So I pick the 320. I compare with 275. So which one is higher? Obviously, 320 is higher. So 320 is my recoverable amount. I will now compare with what I have in my book, which is $350. Okay, $350,000, which is higher. It does not make economic sense to carry an asset at more than their recoverable amount. So what this is telling me is, if I needed to sell this asset, I can only recover 320. So how come I am carrying it at 350? That means it has suffered economic reduction of $30,000. So where do I take that $30,000 to? I take it to profit or loss account. So that's the end of that question. It's as simple as that. Okay, it's as simple as that. Now let me now take you up on the one last thing you need to know around this area. Then I go straight to cash generating unit after solving maybe one question. Okay, now listen, ordinarily, when I have impairment loss, which is the difference between the kind amount of an asset and recoverable amount, just like we said here, I take it straight to P or L account. But let's assume that the same asset that has suffered impairment this year is having a balance in the OCI. What does that mean? Say last year, I revalue the asset. When you carry an asset under revaluation model, you value and market value are the same actually. Okay, so maybe when we take IFRS13, I'll tell you more around fair value. Okay, so now I take it to I take it to the market value. So let me just give an example. Let me give figures so that you understand. So let's say the current amount of that asset is 300,000 at the end of the reporting period. But when I look at the market value, it was 320. So I now revalue to its market value. I have what we call the valuation gain of 20,000. Okay, so I take it to OCI, other comprehensive income. Remember yesterday I told you why revaluation gain are taken to OCI, if you remember. Okay, now I take it to OCI so that I can have a revaluation reserve within my equity in my financial position, in my statement of financial position. Okay, so now this year, that same asset has now suffered economic reduction, which is impairment. Normally, if I have impairment, so let's say my impairment is 50. I'm just giving an example. It's 50. Normally, I would have taken that 50,000 to my P or L. But the standard is not saying. It doesn't make sense, actually, for an asset that has been previously revalued, that has a revaluation reserve within the, what's it called, other comprehensive income, and has now suffered impairment. How can you charge impairment to P or L and the same asset is having a valuation reserve in the OCI? It doesn't make sense. So what the standard is now saying is, if an asset that has been previously revalued has now suffered impairment, that impairment should first be charged to the OCI before taking the balance to P or L. So what does that mean? So if I have 20 in my OCI and 50 is now the impairment loss, I'll first take that 50 to the OCI to the extent of the amount in the revaluation reserve. I can't knock it off more than that 20. So I knock off 20. I have 30 left, and that 30 will now go to profit or loss account. So let's look at the next question. Most likely we'll see something that is similar to what I just explained. So let's take a look. It said on 31st December 20X1, when dealing with accounting, date is very important. Okay, so those dates are not there for fun. They are very important. An entity noticed that one of its items of plant and machinery is often left idle. On this date, the asset had a kind amount of $500,000 and a fair value of $325. The estimated cost required to dispose the asset at $25,000. The asset is not sold. The entity estimates that to generate cash inflows of $200,000 in each of the next 2 years, the discount rate that reflects the risk specific to this asset is 10% required. Discuss the accounting treatment of the above in the financial statement for the year ended 31st December 20x1. Did you see? This guy is telling me to discuss. He did not tell me, according to IAS36, what will be the accounting treatment. He just said discuss the accounting treatment. So let me break it down for you so that you understand how to break down exam. So here he said, the entity noticed that an item of plant is often less idle. The fact that I leave an item of plant idle does not necessarily mean it has suffered impairment, because they didn't tell me the reason why I've left it idle here. It could be there is no work for it and all of that. So this is not telling me that this is impairment. Now said on this date, it had a kind amount of 500 and the fair value of 325. Okay, even with that information, I'm not still convinced that this is IAS36. Remember, in my IAS36, I needed two variables. Although kind amount is reflecting, it could also be PPE, okay? It could also be PPE. Now, it now gave me the cost to dispose. Now say, if the asset is not sold, the entity estimates, can you see, that the cash inflows, that will generate cash inflows of 200,000 in each of the next 2 years. Can you see? Future cash flows, cash flows. So I need to discount to present value. So I have seen those variables. I have seen my carrying amount, and I've seen the component of my recoverable amount. Then I asked this question: where is my carrying amount? He said, guy, can you look at me here? This is where I am standing. Okay, so that's my carrying amount. He has computed it for me. Some questions will not compute. So we're going to solve some questions where it will not be computed. So how do we compute? I think we do that around IFRS5. Okay, then I look at the second variable, which is my recoverable amount. So under that, I needed information about my fair value. So it told me that my fair value is 3.325. Can you see that? So now said less cost to sell. Now I'm going to remove the cost to sell. Okay, what are the costs I'm going to incur? Can you see? So when I net it off, I have 300, but I'm not done yet. I needed my value in use. So it told me that 200 will be generated for the next 2 years. So what do I do here? 200. So I will say year one. Don't worry, I'll show you the solution, but let me explain. Let me explain first, okay? So I say year one, year two. Then I ask, what is the discount factor that you want me to use? You do see, once you ask the question, the right questions, it's going to supply it for you. So it said 10%. So I discount year one, I discount year two, I multiply. I have a particular figure. Okay. So now I compare that figure with 300. Can you remember we got the 300? This 325 minus 25. Okay. So the higher of the two becomes my recoverable amount. I'll now come and compare with this 500. So to tell me whether the asset is impaired or not. So can you see that? So when I did the what's it called, discounting, so I have 347. Did you see that? So when I compare 347 with this 300, that's 325 minus 25, what will I have? I have 300. So obviously 347 is higher. So I now go and compare this 347 with my carrying amount. Can you see? Okay, so it's lower. So that means the asset is impaired. So I write it down. Okay, so I debit P or L. Can you see with 153? That's the difference between the carrying amount and the recoverable amount. And I credit PP so that I can reduce that value. That is it. So that's it. So that's what you're doing, right? Okay. So now let me now go to part B of that question. It said, how would your answer in part A be different if there was a balance of $10,000? Can you see that? If there was a balance of $10,000 in the other component of equity relating to prior evaluation of this specific asset. Can you see? That was what I was explaining earlier. So last year, this asset was revalued. So I have $10,000 in the OCI. The same asset has now suffered impairment. What is the impairment loss? $153,000. Okay. Now say, how will my answer be different? So I will first go to that OCI and debit it. I eliminate it, the whole of that 10,000. So between the difference between, since I've used 10,000, I have 143 left. I'll now take that 143 to profit or loss account, and the whole 153, I reduce my PPE. So that's what you have here. Can you see that? So you have that 143, debit P or 143, then debit other compensating income, that 10,000, and of course, credit PPE with 153. Any question for me? Any question for me? Okay. Any question for me before we continue? So I believe you're you're getting the gist. Okay. It's, my work is to make you understand it first. Okay. So once you understand it first, it will be easier for us to now discuss the mind of the examiner. All right. Okay. Somebody is saying something. I don't understand the last part. Oh, okay. So just listen to me. Okay, so let me look at that question again. He said, that was how I first explained. He said, how would your answer to part A be different if there was a balance of $10,000 in OCI? Okay, so what it means is this asset was revalued last year. Okay, so we have a valuation reserve of $10,000. Now, this year, as at December 31, 2021, the asset has now suffered impairment. How did you get that impairment? Can you remember? You just compare this 347 with 500. So we have this 153. Okay? Normally, this 153 should have been taken to profit or loss. Is that okay? The 153 should have been taken to profit or loss account. But because there was a balance in the OCI, how can I say an asset is impaired? The same asset is now having a balance in the OCI. Okay? So the standard now says when an asset has been previously revalued and suffered impairment, so that impairment loss should first be taken to the OCI. So you now take it to OCI to remove it. Initially you have credited OCI. So you're going to come and debit it without 10,000. I have 153. So you remove 10,000 from 153, I have 143 left. Do you get the point? So it is the 143 that you now debit or you take into your P or L, unlike the 153 in part A of that question. Then the whole of that 153, you credit it into your PPE. So I want to believe you understand now. Can you confirm that before we continue? Any further question for me? All right, brilliant. Thank you. I'm glad. All right, now, so let's move to cash generating units. Jumping. Okay, jumping. Okay, cash generating units. Okay, most times I look at the best way to teach so that you understand. So that's what I'm trying to think about. Even though I've been taking this for how many years now, but every time I keep thinking of how to, lecture it to be more simpler. Now, what we have just done relates to one asset, okay? So let's assume it's a plant like we've done. So the plant is impaired. So it's easier for me. I go straight into that plant and I reduce it, to the tune of that impairment losses. You see, you need to understand the standard, all right? Because when we get to group accounting, we still look at impairment again. And the treatment of impairment, when it comes to IFRS 3 or IFRS 10, as the case may be, will be dependent on how NCI is being valued. Is it valued as proportionate share of net asset acquired or at fair value, right? Where you now need to cross up and all of that. So we're going to find out. So that's why I'm taking some time to, really explain here, all right? So we needed to look into some standards before we start group accounting by next week, by God's grace. Okay, now, so the issue now is, if it's an asset, like we've seen, it's quite easier. But when you have group of assets, for example, you have goodwill, patent, computers, machines, plant, grouped together, and that class of assets or that group of assets has now suffered impairment. How do you allocate to them? Okay. Now, a cash generating unit is the smallest identifiable group of assets that generate cash inflows that are largely independent of other assets. Okay. So they are independent of cash flows from other assets or group of assets. So that's what we call cash generating. So obviously, nobody's going to ask you all of this question, but you need to understand actually. So before I can know the cash flows that is being generated from those assets, you need to put them together. So that's what they call them cash generating units. Okay. So if a cash generating unit has now suffered impairment, okay, although according to the standard, most likely is the goodwill that might have suffered impairment. Remember, that goodwill has to be purchased goodwill. It cannot you cannot recognize internally generated goodwill in accordance with IAS36 intangible assets. Okay, now, so if 5 assets, maybe there are 5 of them within that unit or that group of assets, has suffered impairment, how do I allocate it? Okay, now the standard now says in allocating impairment loss to a cash generating unit, you're going to follow 3 procedures. Okay, you follow 3 procedures. You have to know it. Okay, so you have to know it. Even though in ACCA, I'm not sure the examiner is going to pick you up on this, except it's just asking you if maybe just painted a scenario. You now ask you if they have complied with IAS36 in allocating impairment loss to a cash generating unit. But by writing corporate reporting in ICANN, obviously, it's a cheap question for you. They will ask you directly. They can ask you to explain and give you a question so that you can do that. Okay. Now, you follow 3 procedures. Number 1, we impair obviously impaired assets. Is on your screen. Okay. Impair obviously impaired assets. Number 2, reduce goodwill to 0. And 3, allocate impairment loss balance to other assets on pro rata basis. Okay. So let me say that again. You impair obviously impaired assets, reduce goodwill to 0. That's step 2. Then step 3, allocate the balance. That's impairment loss balance to other assets on pro rata basis. So let me try to figure out some figures. Okay, fine, that's fine. Figure out some figures in my head. So let me use it to explain. Then I'll use a read question to further demonstrate that. So let's say we have goodwill, patent, and all of that. You have their carrying amount. So when you compute the or what's it called, impairment losses, I'm sure everybody can compute that. You look at the carrying amount of the cash generating unit and you look at the recoverable amount. How do I get my recoverable amount? I have fair value less cost to sell and value in use. You have to know it, start reciting it. If you don't know it, you can't solve question. You can't respond. It's as simple as that. Okay. Now, so let's say we have computed the impairment losses. Let me just give a figure. Let's say impairment loss is 150,000. So just a figure, okay? So just a figure. Just, I'll put that in your memory. So 150,000 is my impairment loss. So I now need to allocate it to 5 assets, 5 group of assets. All right. So I have goodwill, I have patent, I have machines, computer, and furniture. Okay. Now, so they have their carrying amount. So I can't, I'm not doing this on the board. So don't let me put figures to that, but let me just try to explain. But impairment losses is 150. So now the first procedure is saying impair obviously impaired assets. Oh, really? Impair obviously impaired assets. So all you need to do is to look at the question, just follow the instruction in the question. For example, the examiner can tell you that machinery, machines, that forms part of the cash generating unit has been burnt to pieces. It has been burnt. What does that mean? And it has a kind amount of, let's say, 30, for example. Okay, $30,000. All right. So it has been burnt and is considered worthless. Oh, that means it is obviously impaired. So out of that 150 impairment loss, I will go to that kind amount of 30 and knock it to 0. That's it. Obviously impaired. That's it. You can also say patent that has a kind amount of 20 can only be sold for 10. Did you see that? It has a kind amount of 20 in my books, but I can actually sell it for 10. That is obviously impaired. So I go there, I reduce it from 20 to 10. Did you see the point? So that's obviously impaired. So you just follow through the instruction, the question. So my 150, I allocated 30 the other time, and I allocated 10. So I've allocated 40, right? So I have 110 left. I'll now say next, if I don't have any other obviously impaired asset, I'll now go to the next step, reduce goodwill to 0, right? That's what the standard has said. So reduce goodwill to 0. I'll just go to the kind amount of goodwill. So let's say it is, let's say 80, for example. Just give an example. So it's 80. So I go there and reduce to 0. So out of my 110, I have 30 left. Okay, so the 30 I have left, I will now apportion it to other assets that is remaining on a pro rata basis. So how do I do that? I'll just look at the kind amount. Okay, let's say there are 2 assets that are remaining. Let me just give an example. Let's say furniture and computers. They are the one that is remaining. Okay, so furniture, the kind amount of furniture is 20. The kind amount of computer is 30. I add it together to have 50. So I now say 20 over 50 multiplied by that balance, which is 30. That's it. So whatever I get will be the allocation. So that's what I mean by pro rata basis. So let's solve questions so that I can explain that better. Now look at this. It said Tinud has identified an impairment loss of 41. In fact, he has computed it for me. He has not computed it for me. I can simply look at the current amount, which is this 150. You already said it here, 150. I compare with the recoverable amount. So if you remove 150 from 109, you still have your 41. Did you see that? So sometimes they compute it for you, sometimes you have to compute it. So now said the current amount of the unit net asset is 150, whereas the unit recoverable amount was 109. The draft value. So we're giving this kind amount. So it now said the net asset or the net selling price of the unit asset was insignificant, except for property, which had a market value of 35. The net monetary assets realized in full required. How is impairment loss allocated to the assets within the cash generating unit? So once you see a CGU question, you always know the examiner cannot hide it, whether SBR or corporate reporting. Even though in SBR they may not, bring it up directly like this. They must have done it. They would have done it. That's the style of ACCA. Okay, they will not ask you if they have done it properly or what are the accounting and ethical issues around that. Okay, so that's what you prepare for. So most likely you may not, but if you're writing ICANN, obviously you have to do it. Okay, so ICANN is still behind. Sorry to say. Okay, but that's the truth actually. All right, now Tinud. Okay, so when I want to do this, you have to do it on the table. Okay, so you have the assets. Okay, let me show you. Okay, so you have your asset, just list it out. You list them out. Then kind amount before the assets. So just lift all these figures. You put it out. So my impairment loss now. I have 41 that I'm going to allocate. Then I'll now ask, is there any asset that is obviously impaired? Is there any asset that is obviously impaired? So here it said the net selling price of the unit asset was insignificant, except for property, which had a market value. Can you see? Property had a market value of 35. My class is property impaired. Grab your key parts and answer me on the chat room. Property, is it impaired? I'm waiting. Please go to the chat room and answer. Property, is it impaired? I'm waiting. Seriously, I'm waiting. Yeah, thank you. I think I saw somebody. Okay. Oh, brilliant. No, it's not impaired. Why? Because the market value is higher than the book value. Thank you very much. Thank you. I have 3 responses. Thank you, TK. Good. Is it daily good, I mean? Then Mrs. Twain, thank you very much. Yeah, brilliant. So that means you are following. So property is not impaired. You see the trick of the examiner. So when you say obviously impaired asset, so you want to, impair. So it's not, okay? So you leave it like that. That means you will not, you will not further reduce property. You leave it at 20. Is that okay? So don't be confused. Then I read on. I said the net monetary asset will be realized in full. So it's talking about this. It's realizing. Even if the guy did not mention it, I can't impair net monetary asset, just like your financial, your receivables. Tina. Oh, okay. All right. I didn't know. Sorry about that. I was wondering. Thank you. Now, so you won't impair net monetary asset, right? Or if it's receivables that is there. Okay. I-36 will not apply to current assets. Is that okay? So you have another standard for that. That's IFRS9 financial instruments. Okay. And the focus will be around expected credit losses and edge accounting. So I'm going to take you that. Okay. I'll just take you some flashlight. In fact, they may not ask you more than one line on that. Okay. And you would have read everything. But it's okay. All right. So, but when we get there, I'll tell you what you most likely see in your exams. Okay, so you won't impair, even if this statement is not there, you apply IFRS9. So, but this is IAS36. IAS36 deals with what's it called, non-current assets. Okay, now, so now I say I have my 41. Do you see the point? And I'll go to step 2. I reduce goodwill to 0, 13. So you come here, you reduce goodwill to 0. Did you see that? So that you can have this 0 here or nothing here. That's kind of amount after impairment. Okay. Now, so you see property, that nothing was allocated to property. Can you see? The same with net monetary assets. Okay. Now, after I've done that, so if you remove 13 from 41, you should be having, is that 28? So I have these three assets left: machines, vehicles, and patents. So all you need to do is to add their carrying amount together. Okay, so you now say, if you add it together, 49, 35, 14, that should give me 98, right? Yeah, that should be 98. So I'll now say 49 divided 98 multiplied by 28. How did I get 28? Out of this 41 I'm allocating, I have allocated 13. Okay, so I have 28 left. I'll now, give it to other assets on pro rata basis. So when I do that, I have 14. So I also say 35 divided 98 multiplied by 28. I have 10, right? The same 14, then I have 4. So normally, if you do impairment loss, you know whether you are right. So if you add this, I must have this 41. If I remove 41 from 150, I must have 109. If I also had this, I must have 109. Okay, so you can see the explanation around that. So that's it. That's what you're doing. That's what you're doing. Okay, that's what you're doing. Any question for me on this before I move away? I'm not sure if I have one more question that we can solve. Oh, there's one more question, okay. But can you take a look at this? Do you have any concern before I move away? Okay. 1 minute, 60 seconds. 1 minute. Okay, no concern, right? Okay, so that means we got that point. Okay, well, let me check. Okay, no concern. All right, okay, let's take a look at one more question. Now, there was an explosion in a factory. The kind amount of the asset was as follows. So we're given. The factory operates as a cash generating unit. An impairment review reveals a net selling price of 1.2 million for the factory and a value in use of 1.95 million. Half of the machine has been blown to pieces, but the other half can be sold for at least that kind of amount. The patent has been superseded and now considered worthless. Require discuss calculation how impairment loss should be accounted for. So I already know this is a CGU. I've seen the group of assets. Okay, so the first thing I need to do is, what is my impairment loss? So I simply look at the carrying amount. Can you see 2.6? Then I look at the recoverable amount. They said the selling price is 1.2 and value in use is 1.95. Higher of the two, 1.95. So when I remove 1.95 or I compare with 2.6, it will give me, what will this one give me? Okay, this will give me, is this 650? That should be 650, right? Yeah, I got it. Yeah, so it's giving me 650. So that 650 is my impairment loss, and I need to allocate to this group of assets. I remember my procedure. Obviously impaired assets. Then I ask a question: which assets are obviously impaired? It's going to tell me. Said half of the machine has been blown to pieces. So I go to the machine. Okay, let me just show you the solution. I go to machine. Can you see $300 million or whatever? So because it's half, so I reduce it to half so that I can have this half. It's as simple as that. Then I move on. It said the patent has been superseded and now considered worthless. That is 0. So I go to patent. Can you see that? So you are allocating 200. So I have allocated 200 and 150. That's 350. I have 300 left. Okay. So you must be watching that balance. I have 300 left. Do I have any other asset that is obviously impaired? No. I move to the next step, which is goodwill. I will now say reduce goodwill to 0. So I come to goodwill. Okay, goodwill is 100. Can you see? I reduce to 0. So I can have 0 here. Can you see that? Now I have 200 left. I will now allocate the 200 between computers and building. Okay, so I just add this 500 plus this 15. It gives me 2000. I will now say 500 divided by 2000 multiplied by 200. So it gives me 50. Then 15 divided by 2000 multiplied by 200. It gives me 150. So that I can have this figure. And that is it. That is it. Any concern? And that's the end of impairment. Any other concern? Any concern for me? Any concern? Any concern? Any concern? Any concern? There's no concern, Abby. We move straight to the next standard, IFRS5. Okay, IFRS5. Okay. Okay, brilliant, brilliant. Thank you. I think I saw one response. There's no concern. That is brilliant. I'm so glad, right? So I'm so happy. Okay, so you have some questions here and some solutions. Just go through them. Okay, go through them. They are very simple. Okay, so at your leisure, that'll be fine. And there are also some exercises there. If you have the time, you can solve them. You can send it to me. I'll be able to take a look. Now, I am interested in this question. Let's take a look at this question 3. Okay, let me just take a look at it. Let me just discuss it. So, if you're writing SBR, means taking into this question, even I can. The coronavirus pandemic has led to economic crisis in recent times. There's a risk that assets may generate lower cash flows than expected. This means that the asset impairment should be increasingly common. However, some regulators have expressed surprise about a relatively low level of impairment losses recognized by many companies post-COVID-19. It is vital that companies adequately identify impaired assets and write this down accordingly. Moreover, companies must disclose useful information about impairment and impairment reviews to the users of their financial statement. Required, in accordance with IAS36, explain when a non-financial asset must be assessed for impairment. My class, you should be able to handle that. When a non-financial asset must be assessed, when there are indicators of impairment. Obviously, if you're writing an exam, don't just say that and move on. So you need to explain, okay? But technically for SBR candidates, it's going to be in a scenario question, okay? And they can also ask you like this. I'm not really bothered about that. I'm bothered about part B of the question. It says, discuss, that's this SBR actually, how accounting for impairment of non-financial assets will lead to earnings management. You see, see what we have been doing. You think you know IAS36 and see this kind of question, then you are wondering, what did I even know around IAS36, right? Okay, so let me just explain. You see, the first thing you need to deal with is what is earnings management itself. Okay, what is earnings management? Okay, all right. So earnings management actually is a type of window dressing. Okay, when you try to window dress your account, that means you try to manipulate your reported profit. You know, so when that comes to earnings management, you artificially improve your performance. So you can take a lot of steps in trying to do that. Okay, so that's the issue around that. So how can I now use impairment of non-financial assets? How can it lead to earnings management? Remember, listen, at the end of the reporting period, I already know that my carrying amount or the carrying amount of my asset is 500,000. I know already. Okay, so I'm trying to now test for impairment. Now, the computations for my fair value less cost to sell, do you agree with me that they are estimates and they require judgment and assumptions? Do you agree? My estimation for value in use, future cash flows that this asset will generate is also an estimate that requires significant judgment and assumptions. All I need to do is to inflate those figures. Look at that. Inflate. That's the word. I inflate those figures so that at the end of the day, my recoverable amount will be higher than my carrying amount. And as such, I would have avoided charging impairment losses. I can use it as earnings, equate to earnings management. It's as simple as that. That's what the examiner is asking for. And that is an ethical issue. Any concern on that? Okay, so you can pick those things up. So let's quickly go to IFRS 5. I'm targeting or let me introduce you to it before the time lapses, so that tomorrow we're able to deal with IAS10, IAS21. Okay, at least let's close those 4 standards for this week. Okay. IFRS5, assets held for sale and discontinued operation. Somebody is asking a question. Let me look at that. Is there anywhere in the material where we can read up earnings on earnings management? Oh, okay. That's a brilliant question, actually. I actually plan to probably have the time to take you guys on creative accounting and window dressing. Yeah, I actually have that plan. Okay, so maybe what I will do is maybe in the material I prepare for next week, I'll just put it there, okay, so you can read it there. Is that okay? Even I had a plan, but I can fast forward, or is it fast forward now or rewind? I'll bring it back. I'll bring it on earlier for you to take a look, because it's something you need to know for you to face that exams. Okay, so brilliant. So don't worry, you get. I have material already on that. Okay, so I'll just prepare it on time. You get it in the coming week. All right. Thank you. All right. Now, asset held for sale and discontinued operations. So normally, when I have an asset, I have an asset for different purposes. For example, I can use it to produce goods or services, and or for administrative purpose, I apply IAS16 PPE. If I have an asset which could be land or building or part of land or building, all right, for capital appreciation or to earn rental income, I apply IAS40. If I hold asset for sale in the ordinary course of business, I apply IAS2 inventory. Okay, so now when I now decide, or probably the kind amount of the asset can only be recovered through sale and a continuing use, IFRS5 will apply. So when I want to sell an asset, okay, I need to apply a standard called IFRS5. That's why it's called asset held for sale. So the question now is this: I am the owner of my asset. So why is a standard around here? I wanted to sell. So why do we need to have an asset around asset held for sale? Don't forget the other aspect is discontinued operations. Okay. So but let's see whether we can deal with assets held for sale at least for this evening, and I pick it up from discontinued operations by tomorrow. Okay, or maybe we still have the time. Now, the question is why why do we have to have standard around this area? We're going to find out, okay? We're going to find out. And this is a popular, there's no diet. The IFRS5 won't come out in ACCA. Now, if you book, in Nigeria, actually, you have 2 sections in the morning exams and afternoon exams. If you book for morning, and there's no IFRS5 there, I can assure it's going to be in the afternoon. Okay, and afternoon and morning section, they're not doing the same exams, 2 different exams. Okay, so just ask God to lead you to book the one that will be much easier for you. Okay, so there's no way IFRS5 will always feature. Okay, even I can aside last 2 diets, the upper diet, IFRS5 is always coming on board. Okay, now before an asset can be classified as held for sale, 2 conditions must be met. So you have to be with me here, okay? Before an asset can be classified as held for sale, 2 conditions must be met. So before I go on, someone is asking a question: which is a preferred section for SBR? Well, I don't really know. All I know is when I wrote SBR, I choose the morning section. All right, so some of my friends choose afternoon section. It's also dependent on the time you are booking. I saw morning section when I was booking. Then when they were booking, they didn't see morning section. They saw afternoon section. If you go there some other time, you see morning again. They're just trying to, I think, make it on and off, available on the system. Okay, so I remember when I finished my exam, so I came out and I saw them. So I was trying to relate, what they asked me to them, although it's an ethical issue, the ones I could recollect. But funny enough, when they got into that exam, it was a complete different exam entirely. For example, in my own, I didn't see disposal of assets. When they got there, they saw disposal. Okay, they saw IFRS5. I didn't see IFRS5. So most of those things I saw was around IFRS15, IFRS16, normal group accounting, and all of that. So it depends. Okay, so you could really, but then it also depends on, your ability to retain things. Some people like morning exams. For example, myself, I like morning exams. I don't like afternoon. Okay, afternoon, everything is out already. So it also depends. So if you feel you'll be too jittery in the morning, for you to relax, you can just book afternoon so that you are there in the morning, you settle down, you do your revision and all of that. But if you think, waking up in the morning, go straight in the exam at 9 a.m. is going to be fine for you, then why not? So just look for what works for you. So what we are going to do, or what I'm going to do for you is I'll make sure I touch every aspect of your syllabus, okay? I think I showed you the syllabus yesterday. So I'm going to touch all the aspects, okay? And I also told you that make sure you attend all the questions. Make sure, okay? Make sure, because even if they needed to give you free marks, they can't give you an empty script or empty response, all right? So make sure no matter how I shall write something, okay? That's very key because I've read so many of the examining team. What they keep emphasizing is if you want us to pass you, please touch all the aspects of the, or let's say respond to all the questions, like attempt all the questions, no matter, even if you're not sure what you're writing, just attempt it. Is that okay? All right, thank you. Now, before an asset can be classified as held for sale, two conditions must be met. Okay, it must be available for immediate sale in its present condition. That's the asset. And the sale must be highly probable. Okay. Now, let me run it through, then I'll come back and explain. So I said two conditions. But don't forget that before an asset can be classed as held for sale, it simply means that the kind amount of that asset can be recovered through sale rather than continued use. So, for example, the kind amount is 500,000, and I feel that if I continue to use this asset, I will not generate more than 200 or 300,000. So, but if I sell it now, I can recover the amount. So I can decide to classify it as held for sale or put it up for sale. At the reporting period, listen, at the reporting period, for me to classify it as held for sale, two conditions must be met. So what are those conditions? The asset must be available for immediate sale in its present condition, and the sale must be highly probable. Okay, now for the sale to be highly probable, the standard assets, an appropriate level of management must be committed to a plan to sell the asset. That's one. Two, an active program to locate a buyer must have been initiated. Three, the price offered for the asset must be reasonable in line with its fair value. Four, the sale is expected to occur within the next 12 months. Last one, there's no plan to withdraw the asset from being sold. What does that mean? Effectively, there are 7 conditions that needed to be met before an asset can be classified as held for sale. For CR exam, obviously the examiner will ask you straight up, okay, and I'll start asking you to list out all of these criteria. If you are writing SBR, they give you scenario question, and the examiner starts to ask you, can you assess whether those conditions have been met? So don't expect straight question or straightforward question when it comes to SBR, okay? But you needed to know all of them for you to be able to respond, okay? So the asset must be available for immediate sale in its present condition. What does that mean? If I wanted to sell my mouse, for example, if I want to sell it, it must be in a saleable condition. Listen up. It must be in a saleable. You see, the trick of the examiner, they paint scenarios that will confuse you. Okay? So somebody is raising hand. Can you just go to the chat room and, put up your questions there? All right. Yeah, just go to the chat room and just put up your comments or questions. I'll address it. Okay. Now, so the issue is it has to be in a saleable condition. So if you needed to make a repair on this mouse, it is not available for immediate sale in its present condition. It is not available for immediate. It has to be available. That means it must be in a saleable condition. You sell it. Okay, so that's the issue. And the sale must be highly probable. So for the sale to be highly probable, you now have these 5 conditions. For example, appropriate level of management must be committed to a plan to sell the asset. Okay, who are those charged with governance? That's appropriate level. Maybe at the board level or at the management level. They must be committed to a plan. If you're an external auditor, for example, and you've seen that an asset has been classified as held for sale, how will you know that an appropriate level of management is not committed to a plan to sell the asset? You can obtain board minute of meeting, okay, but where it has been stated that those assets or that asset should be sold, okay. Then an active program to locate a buyer and complete the plan must have been initiated. It must have started before or on or before the year end. Okay, for example, if you open up newspaper, you see some adverts, that they want to sell this property, they want to sell this plant. Those are the kind of program, to buyer. It could be that they've consulted solicitor, lawyers, as the case may be, and all of that. Then the price offered for the asset must be reasonable in line with its fair value. The fair value of the asset is 3 million, for example. The company wants to sell it at 4 million. It's not reasonable. Okay. Now, what is reasonable in your exam? It has to be at par with the fair value. Okay. So once it's high, higher than the fair value, it becomes a problem. Okay. So now, it says it's expected to occur within the next 1 year. So that means from the date of classification till the next 1 year, it has to be sold. You expect that it's going to be sold. However, if it's not sold after 1 year, you can continue to classify it as held for sale, provided all the conditions are met at the reporting period. And there is no significant plan, okay, or there is no plan to withdraw the asset from being sold. Now, let me bring you up to a speed here before I look at 1 or 2 questions. Okay, then from tomorrow, I'll continue with measurement criteria. Let me bring you up here. Okay, please listen to me. I know you're tired, probably you've been at work and all of that, so we're going to stop in the next couple of minutes. Listen to me. Why is it that the standard is saying it is unlikely that significant change to the plan is being made or the plan to withdraw the asset? So you should know. What it means is it's possible that this year entities can classify some asset as being sold as classified asset for sale. The other year they restore it. Now listen, when an asset is classified as held for sale, 3 things will normally happen. Okay, 3 things will happen. Number 1, they are represented separately on the face of the financial statement or financial position. Okay, they are represented separately on the face of the financial position. What does that mean? Let's say it's a plant or machinery, it's within PPE. Okay, so it's within your non-current assets. So one of those plants has now been classed as held for sale. You're going to remove it and you call it asset held for sale under current assets. Don't forget that to be sold within the next 1 year. And when we dealt with the financial position the other day, I told you that you classify some item as current or some asset as current if it's going to be realized, sold, or consumed in the normal trading activity, and it's going to be within the next 12 months. Did you see the point? So you remove it, you call it asset held for sale under current asset. That's the first thing that happens. Number 2, they are subject to annual impairment tests. Remember under IAS36, I told you that before you carry out impairment tests, there must be indicators of impairment. However, there are 5 classes of assets that must undergo impairment tests. Remember, number 1 is goodwill acquired in business combination, intangible asset with indefinite useful life. Number 3, asset classified as held for sale. So that's it. That's the 2 things that will happen. Right? So the first thing is they are represented separately on the face of financial position, and they are subject to annual impairment test. Number 3, asset held for sale are no longer depreciated. Okay, assets held for sale, you are no longer depreciated. After all, you don't depreciate current assets, right? Okay, they are no longer depreciated. Now, are you thinking what I'm thinking? Okay, I'm not just teaching you, hey, this is what the standard says, but I want you to think. If assets held for sale are no longer depreciated, wow, brilliant. So that means an accountant can actually use it as earnings management as well. They can use it to manipulate their financials. How? I simply classify my asset as held for sale just because I won't charge depreciation. You know, all this depreciation we talk about is not all these $50,000 that we talk about in exam questions. There are millions of dollars, millions of naira that will significantly shape or change the shape of the financial position or probably the performance statement. Okay, so I can just decide to say, okay, this class of assets, can we withdraw them? Let's class them as assets for sale so that depreciation will not occur. Then the other year we reverse them. Did you see the issue? That's why all these conditions must be met at the reporting date. So the examiner should ask you, how can an entity use IFRS5 as earnings management? It's just simply because assets held for sale are no longer depreciated. That's why I say there's no plan to withdraw the assets from being sold. Remember, all the 7 conditions must be met. If you meet 6, you cannot classify it as held for sale. But obviously in your exams, the examiner may not play around all the 7 conditions. It could play around 2 of them or around 3 of them. Just make sure that any of the 2 or 3 that the examiner is playing around, those conditions are met. If they are not met, they cannot classify it as held for sale. So you need to understand that. So let me look at 1 or 2 questions to demonstrate this, and I completed it. On December 1, 2023, the company became committed to a plan to sell a manufacturing facility. They have met one of the conditions and has even found a potential buyer. Did you see? An active program to locate a buyer must have been initiated. But in this case, they have found a buyer. The company does not intend to discontinue the operations currently carried out in the facility. This is a red flag for me. At 31st December 2023, there's a backlog of uncompleted orders. Remember, as at the year end, the asset must be available for immediate sale in its present condition. The company will not be able to transfer the facility to the buyer until after it ceases its operations to operate the facility and has eliminated the backlog of uncompleted customer orders. This is not expected to occur until spring 2024. Can the manufacturing facility be classified as held for sale? The answer is no. No way. Do you know why? Even though they have found a buyer, they are committed to a plan to sell the asset, but the manufacturing facility is not available for immediate sale in its present condition. Why? There are uncompleted customer orders, and the company does not intend to discontinue the operations currently carried out in the facility. So that's what you tell the examiner. They cannot. They're writing SBR. Remember, they frame a scenario and I ask you to assess that have complied with IFRS5. But the examiner just asks you, what are the accounting and ethical issues? You know, what the examiner would have said here is this. After painting this scenario, okay, it will now tell you that your CFO insists that the asset should be classified as held for sale. Then the requirements now ask you, what are the accounting and ethical issues? The accounting issue is that they have failed to comply with the provisions of IFRS, what's it called, IFRS5. And the ethical issue is that the financial statement will not faithfully represent the underlying intent of this transaction. That's simple as that. So that's what you are telling the examiner. You have your answers there. Look at exercise 2. We have about 4 minutes away. So let me look at exercise 2 again. He said, should I look at this? Okay, let me look at 3. Okay, those ones are straightforward. Let me just look at 3. He said, ISOP is preparing its financial statement. On 1st December 2007, the entity became committed to a plan to sell a surplus office property. On 15th December, the survey was carried out and it was discovered that the building had a dry rot. Can you see? You see, once you read, and you understand, you already seen the answer, and substantial remedial work will be necessary. Now, the examiner wants to confuse me here. He said the buyer is prepared to wait for the work to be carried out, but the property will not be sold until the problem is rectified. The standard did not tell me that if the buyer can wait. Okay, so this is just to confuse you. So whether the buyer can wait or not is none of my business. My business is the facility or the asset or whatever the building, is it available for immediate sale? The answer is no, because it said the building had a dry rot and substantial remedial work necessary. Can I classify it as set for sale? The answer is no. Let's look at the part B. The subsidiary entity B is for sale at a price of 3 million. There has been some interest from prospective buyers, but no sale as of yet occur. One of the buyers has made an offer of 2 million, but the directors rejected the offer. Remember, we want to sell at 3 million, okay, and somebody is offering $2 million, and we rejected it. The directors have just received an advice from the accountant that the fair value is how much? 2.5. Did you see that? 2.5. They have decided, can you see? Decided not to reduce it. Can they classify it as set for sale? The answer is no. Do you know why? The price is not reasonable, in line with its fair value. That is it. That's what IFRS5 is saying. So you have your answers there. You have your answers there. So tomorrow, by God's grace, I'll pick it up from a measurement of non-current assets. Okay, they are measured at the lower of their kind amount and fair value less cost to sell. So from there, we look at 1 or 2 questions. Then I take a look at discontinued operations. In 10, 15 minutes, I'll take you IAS 10. Okay, I'll just quickly tell you the accounting issues around IAS 10. Then I move straight away to IAS 21. Then we should be able to close those 4 standards this week. Okay, so we are on course, right? We can cover 3, 4, 5 standards in a week. Okay, so in the next 8 weeks, we are fine. Okay, thank you very much for your time. I want to believe you enjoyed the class. Okay, I will still make the video available so that you can watch it again at your leisure or probably over the weekend before we prepare for our next class next week. Okay, so hopefully we'll start group accounting next week, but I needed to give you solid foundation so that when we get in there, we will not struggle. Okay, thank you for your time. Any question for me? There's no question for me, right? So you need to go and sleep because I'm still going to work tomorrow. Okay, so I want to wish you the very best as you prepare for your exam. Please take time to look at the content of these materials I'm sending. Okay, I did not just a lot of work has gone into them. They are so rich. Okay, a lot of work has really gone into them. So please sit on them. If you have questions, you have my number. You can call. You can send chat to me. I'll be glad to answer your questions. So I wish you the very best. If you don't have further questions for me tonight, and have a very wonderful night rest. Thank you for listening to me. I really appreciate that. Okay, God bless you. Thank you. Take care. Good night.